All right. First of all, if anybody has any questions, as usual, what we do is any questions on anything in the previous sessions or anything in general. Always like to do that right at the top of the class, and that way um, clear those up right away and eliminate any confusion we might have. So if you have any questions, please stick them in the chat, and I will start with those. Otherwise, we will get going shortly. Again, I'm going to run just a little late here because give people a chance to come in. There's still people joining our session. And like I said, JVC is going to be a little bit late because he's at the dojo and he normally handles letting people in and whatnot, the crowd control. So we'll go just a little later so people can drift in. Anyway, once again, if you have any questions, by all means, please stick them in the chat. We've got quite a little push down going right here. So I'm curious to see where that goes. We're right at the lows of the session across the board here. So there could be a trade coming up. I might just scalp it while I'm waiting to get started. This could be an interesting spot to play along right here for a few ticks. In fact, I'm going to do that. Let's see if we can scalp this a little bit while we're waiting to get started. Yeah, we'll talk about journalytics quite a bit in upcoming sessions. But yeah, Peter frequently, at least a couple times a year, offers discounts on the annual subscriptions for the live trading, and that's useful. Let's see if we can scale this right here. If it's getting absorbed, I think it is. Have a quick look at the structure. Again, I'm just doing a quick scalp here at the lows. I may be wrong. I'm decent downside momentum though. So I wouldn't necessarily play short, but let's see what we can do with this. Right on the lows of the session, and there are some buyers down here. Let's do that for our first chunk. Anyway, I'm just kind of warming my brain up here, and then we'll get started. So again, I want to give everybody just another couple of minutes. Yeah, this one I could be off sides here. Let's watch it for a minute. Again, just doing a quick scalp. Probably should put the internals up. Yeah, the internals are really strong to the downside. So something hit the tape that spooked us a little bit, but often those create long opportunities. In other words, you can fade that energy, but it's still pretty strong to the downside here. I'm watching the traded volume, which is what we're going to talk about today. So this is kind of a good example. And again, I'll talk more about the kind of setups that I do after we go through more of the fundamental stuff. But this is an interesting spot. We're seeing absorption right here, but there's a decent amount of liquidity trying to sell it. Okay, let's see if we can get it profitable here, and then maybe we'll get a runner back up into the range. Okay, there we go. We got that. Now we'll protect it, and it got filled. So yeah, that's typical. Anyway, I made a few bucks there. Quick little scalp. Let's put this away and let's get into the class material. Okay, so is it possible to trade without additional indicators like I have on the left side? Again, those are not indicators, Roman. Those are just a statistical interpretation of the range. But yes, oh, good push down there. Wow, and we just hit a new low tick for the session as well. What those do for me, for example, the tick, I just heard it. I have an audio alert on that. I just heard it hit a new low for the session. A little bell goes off in my ear when that happens. And that just means we're hitting an extreme of the equities getting sold. Doesn't mean the low is going to hold or it's going to go. But everything else that's on my screen that isn't these domes or Jigsaw stuff, for example, these 4 charts that I'm going to get rid of is they're not indicators. They're just contextual analysis of what's going on. Like in the case of those little ninja charts, it's just a regression of the range. It doesn't tell me to buy or sell. It just helps me understand in a little more detail what's going on. It's a filter for me. So I will talk about that a lot more. And that's okay. I'll get to you in just a second, Donna. All questions are fair game in the class. So don't worry about, you can ask anything you want. So once you get skilled at doing this, Roman, everything you need pretty much is on the domes. But understanding, for example, what I just looked at, this panel right here, well, understanding what the equities are doing is an additional piece of useful context. It's kind of like if I pop up the 30-minute rotations in the structure. Again, this gives me a contextual view of what's going on and where we are and where the big volume is. And in my trading, and I say this a lot to the TRG people, it's not so much that those things help me make a trading decision. In fact, they don't. They're not things I trade off of. What they do is they keep me from making big mistakes. For example, the ticks were really getting negative there as we push down. And, when they get really extreme, the low is either going to hold and snap back like it did, or the bottom's going to fall out if that continues. And it didn't continue. I haven't heard my little bell ring, and the tick has recovered back up at, not completely, but it's no longer at, minus 800. It's drifting back to zero. So it's contextual. And you're going to hear that term from me a lot. You can't just trade in a vacuum. You have to understand some forms of the bigger picture. And that's what that's for. So can you trade without it? Yeah, I do it all the time. On the other computer I mentioned, computer number 2, which is on my right, it doesn't have any of that on it. It just has domes. It doesn't even have the liquidity heat maps on it. And I trade profitably on that computer all the time. But I take only really obvious, really extreme trades in those cases. And every now and then, and this happened in a class about 6 weeks ago, I'll take a trade over there without having any of that contextual information, and then I'll wake the other computer up and look at it, and I'll say, oh, wow, that makes me wonder whether that was a good idea or not. So that's how it's useful. And it's a very subtle but important distinction between, I don't use any indicators, just to be clear. Indicators are a total waste of time. Everything that I do is looking at the price and the volume in one way or another, and some sort of statistical analysis of it. For example, when we look at this, we looked at this in last session. This is each of the indexes and extremes of the VWAP. And that little push down got us to SD3, the third standard deviation of the VWAP. And that's one of the reasons I was nibbling long there, because that's a really good extreme. It rarely goes beyond that. That's already 99% likely to be the entire range, just again, statistically. It's not an indicator. It's just a way of measuring either the price action or the volume action. And is it at some level that is likely to get traded? Okay, so very, very important distinction. If you have a follow-up question, stick it in the chat and I'll get to it shortly. Okay, let's see. For those with you, I will talk more about the discounts and whatnot. And some of you may not have heard on Saturday at the first session we did. If you're interested in purchasing Jigsaw, I am going to have a discount coupon for us, and it might be inclusive or separately for Journalytics. I just haven't been able to verify what the options are for us there. I'm waiting to get some feedback from Peter, but I will definitely have that information by the time we do the Saturday closing session. Okay, let's see, Donna. Sorry, my question relates to yesterday's TRG class. That's fine. Again, it's all questions about anything that I do in the market are fair game. So the answer could apply anytime. Yeah, they always do. So if I have the choice between NQ and MNQ, why would I pick one with more volume? Usually decide by how confident I am in the trade. Oh, okay, that's a very good question. I don't pick it based on the volume at all. When I will only trade NQ when the market is at a really clear inflection point and I'm not expecting to have to scale the trade. That's the key point. Because scaling around in NQ is really dangerous. You can get, just having a couple on if there's a major move. And remember, when NQ moves suddenly, it can move 30 points. And if you can't break that up into enough pieces and, you have to go in with just minis, you pretty much can do one, maybe two, with decent risk management. But any more than that, and you're just looking for trouble, unless the range is really, really tight. And sometimes that's the case, particularly in the middle of the day. And so that's what I use to make the decision. See, the problem with trading NQ is it moves so much, and that's also the big advantage of trading NQ and MNQ. On any given day, you get, 200-300 points or more of range. And so any entry is likely to be not precise enough, just because there's, today we only have 120 points of range, relatively small range because FOMC minutes are coming up. But, we're busting the low here again. This could set up another little long opportunity. And sure enough, it did. And this is exactly what we're going to talk about today, traded volume. But let me continue answering your questions. So really, the difference between NQ and MNQ has nothing to do with the volume. I watch NQ as the barometer of what I might do in MNQ because there's just so much more volume and money there. Even though at the moment, there's 600,000 contracts traded MNQ and there's only 300,000. Yeah, but it's 10 times the size. So think of it as, 3 million and 600,000. That's the correct way to look at the volume, but that's not what I look at. The answer is about risk management, and it's just so much easier to manage risk with MNQ, even if I'm looking at doing the same size position. Let's say the trade justifies, 5 NQ. It's a whole lot easier to manage the risk with 50 micros than to try to do it with 5 NQ, because again, you only get to go in and out 5 times instead of maybe 50 times, or in my case, I break them up, into 5s typically. So it gives me double the opportunities where I might scale in and out. And because NQ moves around so much, and this is true of any instrument that moves around, YM is another good example where, and so is RTY, where playing the micros makes much more sense. The tiny bit of extra commission you have to pay is irrelevant in the long term. It really is, because that's just the cost of doing business. And your job when you're a trader is to manage risk. And that's the hard thing to really teach people is, people get really excited about indicators and setups and all that. And, you have to have a decent edge. I'm not saying those things indicators don't matter, but you have to understand setups and how to trade them. But the only thing that really matters once you get a decent edge is managing risk. And we're getting a decent push down here, which is interesting. We could end up again with a really good long, but I wouldn't be nibbling into this here yet. It's just too aggressive to the downside. I showed you a quick example of a long scalp a few minutes ago, but it just isn't bouncing yet. So, I wouldn't try that right here. I'd want to see a lot more absorption. So anyway, but yeah, how you decide by how confident you are in the trade. I would submit to you that that's part of it, but I would also, the first factor that I would use to filter that question to decide which to do, I would take that off of this view right here, the fast 5-second regression. See, right now what's happening is we are pushing out of the statistical range. Let me get that little camera or that little calendar out of the way. So we're exceeding the extremes aggressively right now. And so you don't want to trade really here at all until you have a better understanding of what's going on. It's just not a good spot. It could be a good long, and I was able to catch a few ticks there a few minutes ago, make a little money with a long, but the aggression to the downside is so strong that it took out the range at the moment. And again, that's a statistical range that the LRCs are showing us. And we'll talk more about that in upcoming sessions for those of you that are not TRG folks and haven't heard that much about that yet. But it's a really good question, and it really boils down to risk management. Okay, so the LRCs are just for context. They are for statistical context. LRCs are on Ninja. You can put LRCs on any platform. You can put them on Sierra. They're pretty much built into most platforms. You just got to make sure you get the settings right. Yeah, they're all building blocks for a blink. That's a perfect way to put it. A blink is a term we use in TRG for once you understand how to read the context and the market gets to a potential good setup, like this potential long down here, then it's all about execution and risk management. And the more you practice it, the more it becomes automatic. And we call that a blink. There was a book by Malcolm Gladwell a few years back called Blink. And, think about an example he uses in the book, which is a really good one. Someone who's a brain surgeon, they don't think procedurally step by step when they're operating because they've done it tens of thousands of times. But when you're new, it's a different story. You have to think very step one, step two, step three. Another good example is to think of pilots. I fly, not recently, but and I'm not an active pilot now, but I used to have a pilot's license and I understand flying. And one of the things about it that's interesting is, even when you're an experienced pilot, you still use a checklist for takeoff and landing. But in an emergency situation, you often don't have time to do that. You just have to rely on your experience, and that's a blink. So that's absolutely right. We will talk more about the LRCs and the settings for them and what they show, Steve. We're not there yet, and they're not really part of Jigsaw. Remember, what I'm trying to do this class, our mission here, our objective is to go through the Jigsaw tools that I use, the ones I don't use, and give you a really good understanding of how to scalp with a dome with these tools. And like I've said, all through the class, a lot of it translates over to other platforms that have good domes. A good example would be Sierra. But a couple of things don't, and again, we'll talk about that. Once we get through that stuff, this session is going to be a big chunk of it. And then the ones early next week, then we're going to switch to, okay, how do you use this stuff and execute trades against it? And then I'm going to put up the other tools that I use, and I will explain a lot more detail about the interaction and what I use it for. But pretty much this document, I bring this up a lot because this is really important to understand. These are the only things that I use to make a trading decision. Period. End of conversation. I don't use anything else. There are no indicators here that tell me to do this or that. What I do is based on these 6 things. Everything else is contextual. So the internals are contextual, the tick and the advanced decline, all that stuff. The LRCs are contextual. The extremes of the VWAP are contextual. And I will look at those things. For example, while this push down was happening, as I said, we made SD3 here, a really nice extreme to fade. But you had to be really nimble there. That's not what I'm going to trade off. I don't wait till it touches that or whatever. That's technical analysis nonsense. It's just telling me that, okay, this is a pretty extreme spot. So then I look at these criteria, and that's what I make trading decisions on. And then once I'm in the trade, I don't look at anything but risk management. Nothing else matters but risk management once the trade is open. And that's a critical thing to learn. No matter what strategy you trade or whatever tools you use, that statement should be how you operate. Once you have a trade on, the only thing you should be concerned with is managing the risk. If the trade's going to work and you're going to make money, it'll be real easy to manage the profit. The problem most traders have is they can't manage the risk if it's not working. And that's a really, really important skill to learn and develop. Okay, JVC, I see you're with us. Thank you. Welcome.
I am. Hello. Yep.
I explained you were off at the dojo, and we're getting started. I'm just going through questions.
Cool.
And if you could take the room management from here, I'd appreciate it.
You got it.
Okay, so let's see. So we make the decision the same way. Yeah, exactly. NQ movement in the middle of the night. I will almost never trade NQ at night, because it's just too possible to get really offsides. We get a lot of an earnings report hits and the market moves 100 points. That's $2,000 in an NQ contract. It's just way too much risk to take. But, you could play that with a couple of micros and make $1,000, if you manage the risk well. So again, my default is almost always to play MNQ as opposed to NQ. because again, it's a really great tool. But here's the one exception. I just minimized everything there so I could draw. I know everyone loves it when I draw with my mouse here. So let me do that real quick. Here's the exception to that. When the LRCs help you understand the range, and when you have LRCs that are all kind of horizontal and the faster ones are kind of inside the slower ones, this is the perfect place to play the range. So you look at this and you say, okay, the market's range bound, and then you watch the dome and you look for inflections in the traded volume, and that's where you play. And those will overwhelmingly occur, like right here or right here or right here, because once the market's range bound, particularly in the middle of the day, just, think logically, it takes to leave a range. Let me just explain this. So I assume everybody's been through the make ticks classes by now. Why price moves? Price moves when new information enters the market that causes one side or the other to get more aggressive. That's the only way we break out of a range. And that's unusual in the middle of the day. And when it happens, it's really obvious, like the case we just saw. So if you keep an eye on the statistical representation of the range, it's a massive edge, but you have to understand what it is and what it isn't. And it's not a trading system. It's just a way of managing the risk and understanding what the conditions really are at the moment. So here, hang on one more second, and let me put the Jigsaw back up, and then I'll put one other thing back up to answer that question, and then we'll move on, and I'll take other questions and comments. So we came down to this low, and it's pretty much holding down here. And if you popped up that fast view that I was just showing you, where's NQ? There it is. See what I mean? We pushed the extremes of the range, and now we're kind of what I call ebbing and flowing around at the low. And often that's just a pause before it continues down. But also often, look, we're roughly horizontal on the longer term view here. So a lot of times it will drift back up into the range after whatever caused that move down gets priced in. So what this is telling us right now is this is a good place to play. There's an opportunity here. It's an extreme. And so that makes managing the risk of that idea very easy, short or long. If you're looking for it to continue, you want to see that aggression on the sell side pick back up. At the moment, that's not happening, but it's also not getting bought real aggressively. So if you just keep an eye on that and then watch the traded volume on the dome, let's do it right now. Okay, there's buyers here. Can they lift it up? Look how far up, the bottom of the VWAP's all the way up at 81, and we're trading at 40. So the opportunity in that direction is significant if we can see that the buyers are actually holding here. And there's a battle going on. They're not. Now there's a push down through that level, and we just took out some more liquidity down there. And so, this low is probably going to go again, or at least it's in play both ways. So I wouldn't trade this aggressively either way right now. I'd wait till I saw some signs that the buyers were really going to step up here, or the sellers are going to reassert themselves. And a lot of times what happens in the middle of the day is that it just kind of peters out. It just kind of gets sideways. It's ebb and flow at the low in this case. And once whatever the energy was that got us down here dissipates, sometimes we'll have just a slow drift back up into the range. And that's a really good trade because it's real easy to manage the risk. And if you're wrong, it's really obvious, But again, this could be a really good short if that energy reasserts itself. We can see a lot of absorption at 40, and that's right above us. So, if it can't get back above 40, then, it's definitely not long yet. And if it can push down through this low, it's probably going to run the bottom again, and here it goes. And there it is. See what I mean? Now, this just got massively absorbed here. So catching a quick scalp there would be really easy, and I'll just do a really quick example of it. But because of that absorption and all of that energy, a bounce is really likely. But here's the problem with NQ. What if it continues and you need to scale it a little bit? In NQ, you're way off sides here, but with MNQ, you see, you're not. And again, it's real easy for me to capture ticks. And even though this is going down aggressively, I'm seeing really good attempts to buy it. And, there's a good chance to be able to catch a few points. So this is a really good example of that. But the risk to the downside is significant. So I don't want to get too aggressive here until I see that bounce and, maybe get some of it off profitably. Or if it goes really hard down, I could scale it a little bit more. If I was trying to do this in NQ, that would be literally impossible. There's really good buying, but I'm also hearing in my ear, the tick just made a really good extreme again. So we should bounce. There we go. And, gosh, can't even protect that quickly. So, I've got some profit. I should probably try to take it. I've got 5 left. Let's see if we can scale this a little bit more down here. And then again, see how you can work your way around the price and take profit out on each little pulse? That's really hard to do in NQ unless you're trading a really big account. So we don't want that target anymore. So anyway, this is a really good little example. I can pull, like I like to say this is like using your dome as an ATM. I'm just pulling out 20, 50 bucks at a time with a few micros. And, even if the bottom falls out here, how bad could it get with, I've got 10 and I've already taken some profit on this trade. So that's a good example. But this, again, looks like it wants to go lower. So I wouldn't get aggressive here. And I'd see how hard it can push. And again, just for fun, on this example, let's throw that. See, we're right at that extreme of the range. And so tricky spot. I could be wrong here. So I want to look and see if I can get some more absorption. There it is. Okay. We'll scale a little bit more. But again, I don't want to get too aggressive because I'm trading a bounce here. I'm counter trend. And so, this is good aggressive selling, but it's bouncing enough that it's worth trying to scalp it a little bit. And again, this is a skill you get by practicing, and you have to really practice a lot to get good at this. And I'm really good at it, as you can see. Protect the last one, and now maybe we'll get a runner. So there's 50 bucks. So that's an example of how I use that. And it takes a lot of practice to get skilled at doing that. And again, we're getting a little ahead of ourselves, but that was a good example. Just those 2 or 3 you saw me do after the commissions were up about 75 bucks. And that's fine. Again, I do that a lot. But if you're new and you do that, what you're going to do is you're going to keep scaling it as it goes down. And you can't just do that. You have to understand what's going on in the traded volume. And that's actually what we're talking about today. So can you get the waiting room, JBC?
My Zoom window has completely vanished. Where
Here, I'll get it.
Did it
Okay.
go?
Yeah,
got it. Found it. Never mind.
Okay.
We're good.
Okay, thanks. All right. So and that's a really good question, by the way. So all of you guys, keep those good questions coming. All right. So let's get into today's subject. Excuse me. Again, I'm still fighting a little COVID and the flu at the same time. So, and if you really want to understand the essence of the style that I trade, the thing to do is watch those 3 risk management videos in the pit. And we've shared those with this class. I explained both the theory and then how to execute against it. And it's really powerful. But again, if you don't do it right, you can just get crushed, buying lows and selling highs. But in an instrument like NQ that just, it's like a rubber band. When it gets really stretched out, it snaps back really hard. And that's why I like to do it. I'm also a good contrarian. I don't get emotional when I trade. And when I see a lot of selling energy, my reaction's kind of like, okay, when those guys are done selling, we could bounce a lot because everybody's going to be selling. You know what I mean? So I tend to like to think backwards. And we'll talk about a lot of this stuff. It's a lot more than 1,000. Think of this, there's a famous Bruce Lee quote. He says, I'm not afraid of the guy that has practiced 10,000 kicks. I'm afraid of the guy that's practiced one kick 10,000 times. That's me. I've done that trade you just saw me do hundreds of thousands of times using that technique and that style of risk management. And my win rate's ridiculous. It's way too high. It's like 98% right now over the last 6 months. And, so that's one of the reasons I'll take a little more risk, because I know I'm really good at catching the right spots. And I'm also good at managing my way to at least a small profit by where I scale in and out. And that really takes practice. But anyway, we'll talk a lot more about that. Let's see. Did you have mistrade before? Can you rephrase your question? I'm not sure I understand it, Roman. Wrong trades. You mean while I'm practicing it? Oh, yeah. Yeah. but not big losses because I manage the risk. So identifying inflection points is key. Absolutely. Now we're perfectly segueing to the topic of this class, which is, well, how the heck do you do that? Well, first of all, you have to understand the context. And, I'll look at a footprint. Like right now, there's not a price rejector at the low here. And each rotation has been sold. And we're at the low, and we took out the overnight low in EF. So, the market's pretty aggressive to the downside. But that often, again, midday, that often creates good long opportunities because the market rarely makes aggressive new highs and lows in the middle of the day. It's unusual unless there was some sort of news, which is what we just had. So something hit the tape. So yeah, I do have losers, but the trick to this technique is understanding inflection points. Steve nailed that. If you get that part right, then if you're trying to trade at an inflection point that's not holding and you're buying it, for example, it's really obvious and you don't lose a lot of money because it's clear when you're wrong. And there are guidelines I use for that. I don't use, R to R's, looking for 3 times my stop. I don't use stops because it's silly. And instruments that move this fast, a catastrophic stop is fine. That's running over on the rhythmic platform. But on each individual trade, it's silly. They'll just get hit. And sometimes they'll get hit at the exact good spot to double the size of the trade rather than getting out of it. So Steve nailed it. Inflection points are key. So that's what we're going to talk about today. And specifically, seeing inflection in the traded volume. Look at all of these circles down here at this low. Those and look at the white lines around them. Those are spots where we traded into large liquidity and the liquidity traded. And that tells me that there's at least buying interest down here, but it's so far not holding. But there are buyers. If the market is coming down really, really hard, you won't see that. And we saw earlier that that's not what it looked like. If I stretch this out a little bit, look at the drop on the way down, through these areas where it was really thin. There was no interest. Let me filter this. And this is an example of how to work the circle tuner. Let's see, where is it? It's there we go. Let me tune that up a little bit. See if I kind of just look at the bigger ones. See, right now there's not a lot of aggression on the buy side, so we probably could go lower, but we might not. What you're ideally looking for in an inflection point. Whoops, let me trying to put this back, and it's kind of hard to do this with Zoom running. It interferes a little bit with me. There. Okay, put this on and. That way everything will be back lined up. There we go. Okay, so what are we looking for? Well, right now, there are no inflection points in play. That low got sold, and I would not buy this here. Why not? Because look at the traded volume. It's all over the place. There's no clear spot where a lot of trading happened on the bid, on the pink side, and then we went up. There's lots of volume everywhere. And what inflection points look like is they look like, and again, I'm going to grab the drawing tool. They look like a big area of movement with not a lot of volume. And then we get to a spot and you'll see a lot of volume on the bid at the low. That's what you want to see. And at the other end, you want to see it on the ask. This is a nice definable range. Okay, and it might be happening right here. See, that liquidity just got traded. It did the same thing over here. Didn't happen in EF. The liquidity is a little lower down. But look at that. From that spot where that traded, there was a nice little bounce. But there's also a pattern here. The bounces aren't going very far. What you want to do is you want to find those two things to be at least 10 points, preferably 20 points apart in an NQ situation. That sets up a really nice little tradable range. And now we're seeing the buyers step up. See, look at that. The ask is getting lifted. It trades 18, it trades 19. See what so it came up all the way from 13. That's a nice little 5-point move off of this absorption of the liquidity. So that's what you're looking for. The conditions we're seeing right now are not good. So this is an example of places you don't really want to try to trade. It's just not clear yet that there's a strong bottom here. It's, each time we do any buying, like we're seeing, then the low goes and it goes lower. And, for example, it did that at 20 and all the liquidity is forming above it. So defining the inflection points is real easy. You're looking on the way down for it to trade into the bid, roughly hold it. Again, it can move around a little bit, a few points, less so in ES. Here's one happening right now in ES right here. And so, there's liquidity right there at 40. Will that trade and will it hold? Let's watch it. We're at the lows of every other index, and we're seeing a little bit of buying in here in NQ and MNQ, but not enough to be aggressive. So this low is probably going to go. I'm also hearing the bell ring in my ear, which tells me we just made another new low in the tick. And so tricky spot. This is one of those ones where, why wouldn't I trade here aggressively? Well, you can't manage risk. It's not clear what's happening yet. Let me throw the, and see, we're making lower and lower. We're really aggressive on the downside with the ticks. The VIX has gone up a lot. If you bring up the one that has the advanced decline on it, you'll see that's getting pushed down. See, so the equities are selling off. So the futures just aren't going to bounce a whole lot right now. That you could catch some longs, but you're on the wrong side of this if you're trying to play long. And if you get a good short entry, which isn't clear where that is right now, that's probably a smarter way to play this until this down energy subsides. And once we see that, it could create a wicked move back up into, even if we just got up into the value area, that's all the way up here at 75 and we're trading at 17. So there's a lot of opportunity. Remember what I said yesterday or last session also, and I've also assigned this, the classes, the videos about the dynamic range. That's the also covered in the extra videos we gave you guys. But what you're looking for, the best places to play is when you have a good size range. Today it's 157 points. That's decent, but it was better yesterday. We were well over 200. We're at one end or the other, and we're seeing a very tight range form there because that makes it real easy to manage the risk going short or long. And same thing up here. And again, if we've got a really tight range and we're in the middle of it, if it's not volatile like right now, you can play that. But we have way too much volatility and we're not in the middle. We're down here. So again, we're going to go through a lot more examples of how these setups actually work. You guys just don't know enough yet for me to spend too much time on that. So we will come back to it. But again, we're just not seeing any strong inflection points. I'm going to reset these two and we'll let these others stay filled. See over here on YM how at the low there was a lot of volume there, and then what you want to see is, well, where was the volume on the blue side? And the problem was it wasn't. Every spot where there's a lot of buying, we're below that. And this is the only one we've really bounced off of. And there's a lot of blue in here, which means it's not just buying, it's both buying and selling. So it's just a really risky spot to play long or short. We don't have clearly defined inflection points. And that's the primary thing I want to talk about today is those pieces of the puzzle. The most important piece is the traded volume, because that's what people have actually done. And then again, you want to see places where the traded volume is interacting with the liquidity on the side you want to play. So for example, pushing down into the liquidity like right here, that spot got bought and now we're above that. So that would have been a real good spot to play along. And again, we saw that down there on the non-crunched view. This is crunched NQ. This is not crunched NQ. And you can see down there, yeah, that was really clear that the buyers came in there. It was a spot where there's a lot of liquidity. And again, remember, liquidity is people putting up offers or bids saying, I'm going to trade here. But when it moves really aggressively toward that spot, often those guys will get out of the way and they'll trade further down or further up, depending on the situation. So the liquidity is just kind of a previews of coming attraction. It often acts as a magnet too, and this is a really important point to understand about liquidity. The fact that there's big liquidity below us and we're going down, it's really likely to go down there and at least try to trade that. It will act as a magnet in that sense. And there's another reason it will act as a magnet. Very large traders will put up buy orders in this set of conditions below the low, and they'll try to push it down there by selling a little bit into the tape, see if they can get it going. And then what they will do is they'll buy back what they sold aggressively, and they'll catch everybody else off sides, and a little short squeeze will happen, in this case, to the upside. So we're back down at that low. So let's watch it and see if it forms a decent inflection point. The traded volume, see, it's all on the bid side, but it keeps getting pushed lower. We call that slamming the bid. There's no buyers here. There's probably people covering shorts, and the few buyers that are here are getting run over at the moment. So this is not a great spot to play. Even though it's bouncing a little bit, it's probably not going to continue to bounce because there's so much aggression. So this is, again, one where we want to just wait and let it play out. And the most important skill, Roman, that you get from doing this, that you need to develop in this kind of trading, is reading what's happening now and understanding where you should be aggressive and where you shouldn't. And this set of conditions right now, I do a class every Tuesday for TRG people called Care and Feeding of Inflection Points. And this happened yesterday too. I couldn't do the class because we literally weren't getting any inflection points. There was heavy volume everywhere, and that's what's going on right now. The market is in price discovery right now. And again, if you go through the tick maker classes, you should already know this, but there's basically three kinds of price action. The first kind is really obvious when we're in it. We just saw it. It's high momentum. And by the way, see the lows going again. The bid's getting slammed. So you don't want to play long here at all. It's just a really dangerous spot. But trying to play short isn't good either because it's bouncing. So if you're going to try to short this, you've got to try to do it like up here on this high volume node, or some place where sellers might reassert themselves. Maybe up here, you can see there's a bunch of liquidity, and that's on the first part of the high volume node, which is like right in here. Remember, this one's crunched together. So three kinds of price action. High momentum. It's either going up or going down fast. And what we're seeing right now is the second kind of price action, price discovery. It's going both up and down fast, both ways. And what that means is that nobody at the moment agrees on what the price should be. The sellers are aggressive and the buyers are aggressive. So when you see this kind of action, this price discovery, you really want to just stay on your hands and not trade until it goes into the next kind of price action, which is ebb and flow in a tight range. So we have high momentum, we have price discovery, which is high momentum in two different directions, and then we have ebb and flow in a range. And that's where it gets somewhere, like let's say it gets down here around 10, and then it just starts doing this in a tight range. That's telling you, remember the dynamic range thing, that's telling you that at least down here, there's a battle going on. There's enough buyers that they are keeping the sellers from pushing it lower. And that's where it starts to get interesting to play, assuming all the other things give you good odds of a good trade. We continue to see extremes. Again, right now, we are pushing, as far as the VWAP, we're pushing SD3 and almost SD4. But look at the VWAP itself. It's coming down too. So what that's saying is that there's more volume down here than there was a while ago. And so the volume-weighted average price is dropping. So the extreme means a lot less when the VWAP itself is dropping. The extreme could get a lot more extreme before we stabilize. That's how you read that. And it's really powerful to keep you out of, trying to buy this low, for example, when it's not a good spot. On the other hand, sometimes these really sharp moves down are the end of a high momentum move. And that creates something called a high volume reversal. And we talked about these a little bit in the last session. Those are just golden opportunities. And what that looks like is the market, for whatever reason, it's typically news or economic release driven or earnings or whatever, the market will make a really sharp move and then it'll just stop. And it'll ebb and flow for a little while or not, and then we will just get a wicked turn and it'll do that. That is the holy grail of scalper setups because you can play really aggressive here and it's real easy to manage risk. If it takes out the low, you're wrong. And we're still taking lows out. So we have yet to see this happen. And again, look at the aggression. It's trading heavily on both sides of the tape. And so there's just no good odds playing down here at the moment. So let me put this back up. And I want to show you some examples real fast of what high volume reversals look like. And this is where the chart and the LRCs are useful. This was a high volume reversal. This was a high volume reversal. See what I mean? It came down really hard and then it just stopped there. And then it bounced a little bit. You could have played that long, but the second impulse is often a better trade. Came down right to the same spot again. And again, it just stopped. So if you played long here, your risk management is so easy. You're wrong if it takes the low out. But very frequently, what it will do is reverse really hard and you'll catch, look at this. Where was this at? 53, and it popped up here to 06. That's a 50-point winner just off of that one visual thing. So that's, and it also happened to occur right at the edge of the extreme range as the LRCs measure it, which is statistically. So that's a golden opportunity example. We're not getting that right now. We're ebbing and flowing at the low here, and we're not getting the aggressive bounce. It tried to, but it's just not getting anywhere. So this just should immediately say to you, be cautious, be cautious, be cautious, because it ebb and flowing at the low after a high volume, high momentum move down, right? High momentum, one direction, but then it didn't get the high volume reversal. It just stopped going down, and it's not clear at all what it's going to do next. So that's a very, very important distinction. Okay, so let's see. For example, in that trade you did, where and how would I take a loss? That's a risk management question, Roman, and you're getting a little bit ahead of our curriculum. I will discuss that when I get into setups, which is going to happen toward the end of next week and going into the final week after that. But we're not going to do that right now because you guys don't know enough yet for the answer to make any sense. You're wrong, and here's the simple answer. You're wrong, and you should take a loss when the thing you were trying to do is no longer true. So, for example, if I looked at a sudden aggressive move down like that, and I bought it, I said, okay, I want to get long here. The reason that I did that was I saw buying, and I saw that whatever energy got us to that point was waning. Remember, if you look at the document, it's about the change in the energy. Which way are we going right now? With how much momentum, and how is the momentum changing? So, for example, if I'm buying the low of a range, then I want to see a lot of momentum down to there. And then when it gets there, I want to see it trade into the liquidity. I want to see the liquidity trade, and I want to see it at that point start to go the other way. Then I know that the thing that I'm doing, buying that low, is the right idea. What does it look like when it's not the right idea? Okay, it trades down to that spot. And again, you can't just pick one price. It has to be a range of prices because NQ doesn't respect one price. It's too thin to do that. It will trade, for example, it will trade up to 20 going to the upside. It'll break through 0, and trade up to 20. That's typically a really good spot if it got there with high momentum to play it and fade it. But when I say that the 20 is where I might start fading that or shorting it, what I mean is from 20 to 30 is the area that I will do that. That's the sweet spot of a sudden move from 0 up. If it gets much above that, then the thing I'm trying to do is just wrong. So that's where I would take a loss. There's no mechanical way you can do it. The market doesn't trade in R to R. You can't say, well, I'm looking to get 3 times my stop. You can't do that because the larger traders will just look at a spot like that, and they know retail traders are thinking that. So they'll take out the low or the high really aggressively, and then they'll immediately turn around and fade it the other way aggressively. And the purpose of that is to run stops, and they do it all the time in NQ and MNQ. And people that are thinking in terms of fixed stops and fixed targets will always get taken out at the perfect spot. And if any of you have ever traded before, I'm sure you've experienced that, where you were short or long and you got taken out of your trade and then it immediately reversed and you would have been profitable. That's why, because you let them take advantage of you, because you're not managing risk in terms of the idea. You're trying to do it in some sort of fixed ratio, and the market doesn't do that. That's just a complete set of nonsense that you constantly see on Twitter and Facebook trading groups, and it's meaningless. It's statistically useful to measure your past performance, how big are your winners, how big are your losers, but in the heat of a trade, it's useless. Thinking that way will only hurt you. So that's the answer. And again, it'll be more clear once we go into more detail about the setups and what we're looking for, and when is that whatever thing we're looking for not actually happening. That's where you're wrong, and you get out of the trade. And a key part of that is having that decided before you enter the trade. You can't change that on the fly. And that doesn't mean I won't add to a loser, because I'm not adding to a loser. I'm trading a range and I'm scaling in and out of that range. And you just saw me do that. I was unprofitable as it went against me, but I could see the buying coming in. I knew it was aggressive enough that I could get out profitably, but I wasn't prepared to be really aggressive, because if I was wrong, it would have fallen really hard. And it did that after I took my profit. So again, it's about learning to manage the execution. And the execution is about managing risk. That's all that matters. You will not find or be able to buy any indicator that will help you do that, because there aren't any. The indicator is watching the traded volume, because it tells you what's happening. Right now, we're seeing some selling right up here at 32. So if you were looking to be short, this is an interesting spot potentially to do it. So let's reset this one dome and see if that continues getting absorbed. It'll probably trade back down to at least this volume here at 25, if it continues to get absorbed. If it tries to be absorbed like this and then it pushes above there, then that area is no longer, and boom, just like that, that's no longer true. So I wouldn't be short there. It's got to go higher up. Probably the best short idea is all the way up here at the bottom of the value area, and that's 40 points higher up. So this is just saying not a great short. There's some absorption. See, it's trading into the blue side, they ask, but it's just not going down. We're building a really tight little battle here, and we never know how those are going to work out. It looks like it could be a short. That's what I would play if somebody said, well, you have to trade, I'd be short here. And there, I would have got, all right, there I would have 3 points. And again, I'd be looking for it to trade down to this high volume node. That would kind of be the general area I'd be looking for a target. And there it goes. We're almost there now. So, and see that was the high volume node. Traded volume showed an inflection point forming there, but this is a really bad one because there's way too much volume on both sides. When we do other sessions, when the market isn't quite as volatile, we'll be able to see really clearly where those form. And again, I just never know on any given day what conditions I'm going to get. They're different all the time. And today is going to be weird because we have FOMC minutes coming up. And so the market is in price discovery. Again, price discovery means that people cannot agree on the value. So the market's exploring up and exploring down, trying to find value. And at the moment, it's unclear where those spots are. So, you can't really be aggressive doing anything. It doesn't make sense. Also note where that little burst of selling came in. Right at the intersection of the faster LRCs. So again, that's telling you that statistically, that would have been a decent spot to look for a short. And that also happens to be, not coincidentally, that's what this measures, where it broke down from here. So the odds are good here for a short, but you can't just be short. You have to watch the traded volume. And again, that would have set up a nice little 8-point trade. But again, we're back up at that same area where the absorption was, and there's volume on both sides of the tape. So again, we're not seeing clear examples in this particular session because there aren't any. And that's the nature of the market. When the examples are really clear, it will be really visual to you, and you jump in and you take the trade, and those are really good, profitable trades. When the conditions are price discovery like this, flip a coin. you're gambling here because we just don't see enough dominant energy one way or the other to play it. And remember, the most important thing once we are cognizant of the time of the day, and this is the middle of the day on FOMC minutes day, and so we should expect ranges not to be respected, and we should expect price discovery. That's typical in the middle of the day on FOMC minutes day. So number one is telling us to be careful or not trade. Number two is telling us what we're going both ways. We don't have a clear direction. We don't have clear momentum. So again, number two here, and these first three are the most important. That one's saying, you know what? No good spot to trade here either. And then number three, sweeps. Remember, I explained what sweeps are when a big order comes into the market and moves it right through a bunch of liquidity. Well, we're seeing sweeps in both directions over and over again. You can see them right in here on the pattern of the traded volume. Big sweeps down, big sweeps up. The market's in price discovery. So sweeps are not going to be helpful trading this. You know, if I was looking to be short here, I'd want to see sweeps to the downside and no sweeps to the upside. What is that telling me? It's telling me the aggressors are playing short. But that's not what's happening. We're getting them both ways. We have aggressors both ways. And it's a coin flip which way this wants to go right now. And then, you know, if you clear those three things and you have a good idea, then the next thing is, all right, where's the liquidity? And the liquidity at the moment, let's look at it. It's right where we are. We're trading into big liquidity in NQ. See, we just traded into it and reversed right there at 38.50 and a blue high volume node. So that was on the ask. In other words, that got sold there. The buyers got absorbed, but we only dropped 4 points. So this is a really dangerous environment. It's going both ways. There is no clear direction at the moment. So you just don't want to play. It's that clear. And so what you do is you sit on your hands when the conditions aren't clear. And then again, if you get past a good liquidity filter, like, okay, we're on liquidity, it's getting sold, then you need to look at the range. Is this a spot worth playing? Are we in one of those, really good dynamic range situations at one end or the other or not? We're not. So that one, we don't pass that one. And we're still not at the high volume node. There's a big one up here. We're above this one that I talked about earlier, but we're kind of in the middle of them, and that's always a dangerous spot to play. So that particular item also says, nah, I wouldn't trade here. So that's how the tools are useful. And when, again, it looks like good absorption here. So let's reset it and see if we get any downside traction. We again, see, there it is, a good sweep down. All right, so if you were short there, you're in good shape. You could protect it, and you could have grabbed, a quick 3 or 4 points, but it's bouncing again. See what I mean? This is a market that's going both ways with equal aggression. So the traded volume is telling you, and that's the key to today, is understanding the interaction of the traded volume and the liquidity and the other elements that I just had up on the screen. This is telling you to sit on your hands. And so, it will. If you trade when the conditions are optimal, you're much more likely to make money. And if you avoid trading when they're not optimal, I mean, this is common sense, but a lot of people don't trade common sense. They try to trade an indicator or their emotions. And today is really clear. The market is being very clear as to what's going on. It doesn't know what value is, and it won't figure it out until we get the FOMC minutes, which is why I scheduled a bonus session for you guys. Make sure you register for it, please. It starts at 10:45 my time, which is about an hour from now. And we'll wrap up at the top of the hour here, maybe a little after that. So we'll have about a 45-minute break before that session. But that's where we'll see the resolution of this price discovery, or at least an attempt to resolve it after we get past the FOMC minutes. And you can see that here's a useful use of the economic calendar that's built into Jigsaw. See it down here in the lower left. Big red dot there at 11 o'clock my time, FOMC minutes are coming. That's a warning. You don't want to be in a trade when that happens, but you could certainly play the reaction to it, and that's what we'll be doing. So I need to take a 2-second break here. Yeah, I'll talk to that. Let's see, AirCal, I'll talk to that comment. That's a really good comment. You see that all the time. So anyway, I'll be right back. And is that trading the down?
That's the link to register for the FOMC.
Oh yeah, okay. So let me take a quick break. I just need to go do biology here. I've been drinking coffee all morning. And I'll be back. And why don't you guys who haven't registered, please register, because you will learn a lot in that session. And we will see really clear examples of inflection points, Steve. They will be really obvious when the market goes into a reaction mode to whatever the minutes say. And, what traders are looking for is forward guidance. What was the conversation? The minutes, we had the FOMC meeting. We know the result of the meeting and what they did, but we don't know who said what and how important, how much importance they put on it. And that's what we need to know. And that's what the minutes will tell us. All right, I'll be right back. All righty, I am back. So I love that comment. Yeah, they're hunting my stop. You hear that all the time from newbies. That, even if you're trading 10 NQ or 20 NQ, they're not hunting your stop. They know where a typical retail trader will trade. For example, a typical retail trader will buy a double bottom. Okay. Here's an example of it right here. Okay. So it came down and we stopped here. And then it traded just a little bit lower and it made what a retail trader would see as a double bottom. So at this spot, a lot of retail traders would say, oh, wow, double bottom, I'm going to buy it. Yeah, and they will just flush the toilet on you and take it lower, just enough to take you out of the trade, and then it'll bounce. And yeah, they're not going after your little stop, Mr. One Lot. That's funny because a lot of traders think that they keep coming after my stops. Number one, they don't know where your stops are. Stops don't appear anywhere. They become market orders when the price trades there. But this is another huge misconception. I see people who use Bookmap always saying this. You can see where the stops are. No, you can't. Stops don't appear in the liquidity or the traded volume because they're artificial orders. What a stop means is if it gets to this price, put a market order up for me to sell or buy. That's a stop. But until that happens, and this again is covered in the tick maker courses that you guys all got for free with it. Until that happens, they are not appearing there. They can see where the stops are. No, they can't. They can guess where they are. Absolutely. Because retail traders always use the same R to R nonsense. And that's exactly why it doesn't work. So yeah, that's funny, Erical. That's
if anything, they're just hunting for liquidity. That's all.
Exactly.
They know where it's likely to hang out. So
exactly.
They go there.
And you can say, and that's why it's really critical on here. That's why I say, where's the liquidity? And if there's nearby liquidity, did it trade when we touched it the last time? If it puked, in other words, if we trade the liquidity and then continued to move, how far, by how much? Because that's telling you the nature of the passive traders that are putting up that liquidity. Are they covering a short or are they looking to get long or both, and how aggressively? So again, once you learn what you're looking for, it's easy to practice, but you got to get rid of all the, R to R and stops and, all that crap, because that's just going to confuse you. Here's another good example. We have price rejector at the low, price rejector at the top of the previous period. And, we came down pretty aggressively. This is EF. I bet in NQ, even in crunched NQ, there's probably some, the perfect example here. So, look how fast it trades through thin areas like this area here. There was just no interest there. And there was some absorption on guess what? These are people that absorbed buyers. And once we got below that spot, the toilet just got flushed. And the low down here is not a good one. There's no price rejector down there. So, you see this over and over again. And if you look at a footprint of the whole session, which I've got running on my other monitor, there's another phenomenon, which I don't know if we have any right now. Let me see if there's any single prints. No, not really. So anyway, when there's good examples of some of that stuff, I'll show it to you. But right now there isn't. So keep an eye on the waiting room, please, JVC. I just let someone in.
Missed that one. Yep.
Yeah. Okay. Cool. So let's see. I think I covered all the questions. Yeah, I did. Okay. So, again, I really want you guys to drill in and focus on this. This is what matters today. And it matters every day, but this is the topic that we're talking about that's really important today. Watching the traded volume understanding the interaction between the traded volume and the liquidity, like right here, we're right there again. Let's see what happens. Okay, see, it just plowed right through that, and there was a blink. You'll have to go back and look at the recording. The liquidity suddenly appeared right above the price, but it didn't trade, and it jumped back out of the way. But we traded right through that old high volume node. It went a little bit lower, and that liquidity got bought, and it moved us up. So the interaction between the traded volume, see, right now we have a baby inflection point right here. If this low can hold, we could go up quite a bit. So let's watch that low. And again, it happened right into the liquidity. It did trade. It pushed it a little lower. So if you're long here, that spot has to hold, that 24.25 area. If it doesn't, the next spot down in play is 20. So you're going to be 5 points off sides really fast if it comes through you. But at the moment, it's a good long. But it didn't just trade to that one spot. See what I mean? It just took it out by a few ticks, and then it reversed. And that's very typical. And that's why trying to do this in NQ, where you don't have as much room to scale in and out around, a 5 or 10 point range, just makes it a lot harder. It's much easier to do an MNQ, and the tiny bit more commissions you pay, are irrelevant, really. So that's the key thing I wanted to talk about today. And again, the other thing on the domes are these flip charts at the bottom. And keep an eye on those. I'm going to show you the default view of the Jigsaw domes with the stacking and pulling on them. I'm going to show that to you in the first session next week. But the flip chart summarizes it really well. And if you just kind of watch that, look what happened when we came down. See how it got red for a minute right at that same spot? So the order book got negative just long enough to get through that area, and then it flipped over again. That's why that's called a flip chart. And the aggression was on the buy side. Now it's on the sell side again. And in a market like this that's in price discovery, this is typical. The flip charts will just keep flipping back and forth. But on a high volume reversal, it looks like this, where you just see all one color and then a tiny bit of the other color. And that's why the comparison between the crunched NQ, this one, and the NQ that's tick by tick is so useful, because you can really see, kind of a summary of that. And that's really powerful. And that's, again, why I use this subset of the various Jigsaw tools. The tape with everything on it gives me a sense of the momentum. The block one shows me, a spot where a lot of blocks went off, which is typically happening at inflection points. If it's not an inflection point, you won't see a lot of blocks. But if it is one, a big trader isn't going to go in and out with one lots. They're going to throw 10, 20 lots up. And you'll see that in that version of the tape that's filtering for that. It will still appear over here, but it will go by too fast, and you won't see it. This whole view goes by in seconds, like that, when we're busy. But now there was a 10 right there, and now that's right. We traded right below the bid. So this could be a long right here. If this spot holds, remember this was in play a minute ago, 24. I wouldn't touch this till 20. Then I would be interested, because there's a bunch of liquidity down here at 20. Let's see if 20 holds. I missed it. I was going to grab 20, and by the time I got over to my button, we're at 24 again. Now 25, now 27. See what I mean? That's a perfect high volume reversal right there. It just happened, but it's right on the edge of the range, and there's a whole lot more range below us that we could explore. So you just couldn't be aggressive. If I could have got a market order off there at 20, I would have caught a 6-point winner. I was about to get my mouse over there as I was explaining it, and that's the danger of teaching and trading at the same time. By the time I explain it, it's over. And that's also the problem with any technical analysis indicators. Any technical analysis indicators showing you a potential trading inflection point, by the time they show it to you, it's over. It's already happened, and that's why they're useless. Stuff like moving averages or MACD or RSI or any of that nonsense. It just, by the time those things signal, the trade already happened. And that's why you have to learn to read the traded volume and its interaction with the liquidity. That's the critical piece. And you're looking for inflections like that one at 20. And look at the liquidity. A whole bunch of liquidity keeps asserting itself there. We might get this trade again. So let's get ready for it this time. If we can get an aggressive push to 20, even down to 17, that's a perfect little long nibble here. And we're in this high volume node right now. Remember, that's one of the criteria. So let's see if we can, again, right in here is where I want to try to buy that. And and I'd be aggressive down into here, maybe as low as 10, but no lower than that. So that's the answer to Roman's question. If I bought 20 and maybe nibbled into it a little more around 15, I'd be wrong on that idea if it traded down through 10. And that's where I'd bail. And that wouldn't cost me a lot of money with 10 micros, right? Okay. Any questions or comments at this point? We're right on the top of the hour. And what I'm hoping to do is get through questions and the last couple of points I want to make so we can wrap and everybody can take a little 45-minute break. Here it is right there. Okay, I took it at the market. Going to let it try to come to me here. Let's see if we can just catch a quick scalp. Pushing down pretty aggressively. I'm right on the liquidity. Let's see if I can get a fill there. If not, it'll at least bounce up to 20 and I can peel off a $20 bill. That's, actually 22 is where the last aggressive volume was. But again, if it goes below here, I'm probably wrong. Oh, there we go. Okay. So again, I'll let this go down to about 10. And below there, that's where you can see there's liquidity down there. So this is exactly what I just described. So this one I might be wrong on. Let's play it. 10 trades. Actually, I front ran that a little bit. And I'll take one more here and I'll take as many as 20. I'm seeing some absorption. There we go. Now we're going to sweep up. Let's take off the first chunk right here. We'll grab a $20 bill from our ATM. There it is. Get the other chunk off and then maybe we'll catch a runner. We got 8 left here. Let's get another. Move that down. I want to get out of these other 3. So we have 5 left. There we go. Now we can protect it. And it goes or it doesn't, but I've got my profits. So probably not going to go. It's probably going to, oh, there we go. Okay. There's my $20 bill. There's 25. There's 30. Got it. So that's exactly, I described it and then it happened. I can't end a class on a better example than that. So let me pause and let you guys give me some questions. But Roman, that is exactly the answer to your question. You just saw me do it. And remember, before I opened that trade, I told you where I was wrong. And so that's risk management. I know I'm wrong below 10, but I'm going to be pretty aggressive between 20 and 10 because I know that area tends to get bought. So as long as I'm seeing it getting bought and I'm seeing the liquidity trading, which look at that right there, it traded right into that liquidity and it bounced. So that was a perfect example of that. If I show you a few more circles, I've got them filtered here. Let me unfilter that a little bit and you'll see that was a little high volume node. See, that was a little too unfiltered. Let's do that right there. See, this was where it got sold from. It pushed down, the buyers jumped back in, and now we're back down there. So I actually executed that almost perfectly. Okay, liquidity range trading between IPs. I don't know what you mean by that, and that's not exactly correct. You want the liquidity at the IP. So, if you have really clear inflection points on both sides of a large range, that's the holy grail. And what would that look like? We would have, a big, here's the blue is up here for argument's sake, and we trade down really aggressively, and there's not a whole lot in the middle, and that's not what we have today. That's the problem today, as I've said. But there's some buying right here at 13 to 10, 13 to 12. So we want to see that on the bid. And ideally, the distance between these two is at least 10 points. 20 is better. Because then if you're buying here, you've got a good range to move back. And you can see it's bouncing again from that exact same spot. See, this is where all the liquidity traded, right there. And it got all the way back up to here. So that's only about 8 points, though. And that's not enough for a good setup. So this is an example of a crappy setup. I managed to get profit out of it. I'm really happy I could pull out, $50 or whatever that was out of that because, considering I only had 20 micros, that was perfect. I paid $20 in commissions and my dome is acting as an ATM for me. And, I might do that 10, 15, 20, 100 times in a day. And, 99% of them will work. And the one that doesn't work, I might lose $100. So one thing I want to call your attention to, because it's a really good way to see, examples of aggression. And you can go look at these trades and then go back on your chart and see what was happening at that time. Remember, in the anything goes stream, scalping micros this AM, I post here most days, and just scroll back. Pick a day where there's lots of trades. Some days I trade more than others. And let's just randomly find one. Here's a good one, probably. This was during the Trading the Open class. And you can see, there's a couple spots I got aggressive, 45 there, and I made 120 bucks. So after commissions, I made 80 bucks. And but I scaled into that over a big range. You can see that MAE is bigger there, and that's why. But it was very profitable. This was 100% winners. But on that one, I guarantee you I was a little bit offsides. This is a better trade here where I only had 10 micros and I made 175. This is an example where I bought an extreme and I was right away. If you can trade 10 micros, and pull out that much profit, that's ideal. And so I encourage you to scroll through here and just look. And, I don't get them right every time. You will see a few losers in here. You'll also see days where I mix up NQ and MNQ, and you can see the results. Once I'm doing well with MNQ trades, sometimes I'll switch to NQ, and you can see me going back and forth here. The MNQs are working with small amounts, so I go to NQ and trade. Look at this. Here's a 12 NQ, so I'm being pretty aggressive, but I'm getting nice profits out of it, and with a very low MAE. So, that must have been some sort of extreme. This was a $2,000 day. And, it made up of, the biggest trade, 300 bucks before commissions, and, a lot of little ones. It always adds up. The trick is to be consistent and practice. So here's another one. Made one mistake. This is later on in that same day. I think this is another one. Yeah, here's NQ and MNQ mixed together. And sometimes, look here, today, on this particular day, MNQ was much more profitable with a little bit of scaling. The few times I tried NQ, I made money, but I decided it was too risky, and I went back to MNQ. So you can see, this goes to your question, Donna, you can see where I chose to do that. And pick a day. The date's on here. Pull up a chart, and you'll see, what I was thinking. It should be pretty obvious. And again, this goes back years. So you can literally just keep scrolling and just pick a spot. Here's another good one. Little loser, lots of good winners, $5,000 day. I don't know what else to say. The technique works. There's no magic indicator. You don't need to buy anything. All you need to do is learn how to do it by practicing it. And you just saw a couple of good examples of that as well. All right, I'm going to start wrapping up. So I want to, again, start asking for questions. And then we'll wrap this session up, and then I'll have about a half an hour before the FOMC minutes, and hopefully you'll all join us for that. Consistency is the holy grail. Absolutely. And you know how you get consistent, Bob? You practice. There's something in the pit. I haven't put this in your stream yet, but in the classes stream, but it's in the pit for TRG members, and I'm going to copy it real quickly. Practice. I think I've shown you this, but should you be practicing right now? A little flow chart on that. So I'm going to save that, and I'm going to stick that in the classes stream as well, so you guys can look at it, because that's really, you're right. That is the way you get good at, the way you get consistent is you practice. It's that simple. There's just nothing else that matters. You learn the technique by practicing it, and your losers will always be much more educational than your winners. So don't result. That's a term from the Thinking in Bets book. Don't look at your quality of your practice by whether you're making or losing money. Look at it by how well you follow the process. Are you practicing the correct process? And I'm going to talk a lot more about processes in the upcoming classes, how you can build a process. But an example of one, just while we're looking at stuff that's in the pit, in that same stream, I used to make little flow charts of the process that I use. Here's an example of one, how I make scalp decisions. Remember I said there's 3 types of price action. And if the market's in HMOMO, high momentum in both directions, that's price discovery. And so this is kind of a little flow chart through it. And again, I'll go through an example of this in an upcoming class. So that's a preview of coming attractions. Okay, so what questions do you guys have? Oh, we're down at the low again. Could this be a long? Maybe, but you know what? It's getting awful close to the FOMC minutes. I probably wouldn't trade at all now. It's probably just going to get erratic. So good time to sit on your hands. Um, let's see. MNQ too often goes far farther than you take profit. Um, you take whatever you can get, Roman. You don't. The trick once you're in the trade is to manage the risk. You do that by taking profit very quickly. Remember, I have 3 rules for every trade I do. Number 1, a good idea will work right away. If I'm in a trade and it's not working in a minute or two, I'm wrong early or late. In any case, I shouldn't be in it. Okay? Rule number 2, don't lose money. How do you not lose money? You protect the profit the second you have it. If you only get $5 net profit out of a move that then could have given you 500, that's a good trade because you didn't lose money. You have to learn how to not lose money first. And then you can shoot for bigger profits. You can scale up more. You can try to get more out of a trade. But the first thing you always want to do is protect the trade right away. If you can't do that in MNQ, a trade will give you a whole bunch of profit and then reverse, and you'll be upside down. And so you just cannot let that happen. It's that simple. There's just nothing else to that. Yes, process leads to profits, not the other way around. So, there's no such thing as only taking 5 points. 5 points is a great trade, Roman. You're just not thinking about it. Sounds like you're using a lot of, again, stuff that I'm asking people to disregard. Be a tabula rasa. Everything that you need to do this well, I'm showing you. You don't need anything else. And the worst thing you can be doing is thinking in terms of R to R, how much profit you didn't take in a trade. Oh, I left too much on the table. That's rookie trader nonsense. If it was a profitable trade and you executed your process, it's a good trade. If you didn't lose money, it's a good trade. That's what you're doing. You're practicing the management of risk. You can, yeah. Oh, absolutely. The trailing drawdowns will kill you if you're trading with the eval prop account people. Absolutely. And that's even more important why you trade the way I'm showing you. I can let it go a little bit against me. That doesn't hurt the trailing drawdown. But any profit that I don't immediately protect, here's an example of that. You're absolutely right, Ercal. This is one that Lee likes to use. If you have a quote unquote $25,000 account and that has a $1,500 drawdown, if you have 10 days in a row of the following situation, if you have a $200 profit in a trade and you only take $100 of that profit, you can be profitable 10 days in a row. And guess what? You hit the trailing drawdown because you didn't exit your trades protecting your profit every time. You can't give half of it back trying to get more. That might be something, you try to do in a cash account where you've got more room to manage risk. But if you have a trailing drawdown, you have a profit, you have to take it. Because if that profit goes back against you, your trailing drawdown is coming up underneath you. So, if you have a trade that goes plus $500 and you get $100 profit out of it, you're like, well, I still got profit. No, what you did was you just increased the trailing drawdown below you by $400, and that's really bad, even though you had a profitable trade. And that's why that is critical. You have to take profit. You have to protect profits. Absolutely. Massively a good point. I'm glad you made that. Yeah, you left money on the table is total nonsense, but you hear that all the time, particularly if you're trading with an evaluator. That's the way they hope you will think. Because if you think that way, the trailing drawdown will hit you and you'll have to buy another account. And that's the business they're in. They're not in the business of partnering with you in a funded account. If you do that, that's great. They'll copy trade you and you'll both make money. But 99% of the people in those evals blow their accounts up because they don't understand how to manage a trailing drawdown. You have to protect profits. Critical. Glad you made that point. It is so true. Yes, that is. Oh, Bob, I've watched you going through that process of learning, and yeah, it is completely critical. Consistency and not thinking emotionally about your trade. You just have to, the one I just did. You have to think about it before you do it. Understand exactly what it is you're planning to do. Not change it once you're in it. And if it gets to the spot where you already predicted you're going to be wrong, because the idea is no longer true, then you just have to get out of the way. You have to accept that loss and take it. And if you manage risk properly, those losses should never amount to anything. It shouldn't hurt your account. My risk management is like this. If I'm trading a $50,000 account, for example, with a $2,500 drawdown, I might typically make 500, 750 bucks a day in an account like that. The most I will ever let a day go against me is 1 or 2 times that amount. So, I would never let anything go beyond $1,000, for example, because I can make that up in 2 days and it won't really get me anywhere near the drawdown. So that's how I manage risk. But I'll put a circuit breaker in Rhythmic that might take me out if I get to the minus $200, because that gives me a spot to pause and think about it and to check my emotions. And I'll talk a lot more about those kind of fine-tuning details when you guys are a little further along in the curriculum. Okay, we're going to wrap up in just about 3 minutes. So I'm going to start asking for burning desires. And yeah, Steve, everyone's done it with the trailing drawdown. Oh, no, they don't necessarily copy you unless they think you're really good. But the vast majority blow up their accounts. How often do you see people posting, oh, I passed my 10 PAs, and, then 3 days later, and the guy's like, oh, and I did it in 1 day. And and then I'm just going to trade a micro a day until I get funded. And then the exact same guy will post 3 days after he gets funded that he blew up his funded accounts, because he doesn't understand the trailing drawdown and risk management. He thinks because he passed in 1 day that he knows how to trade, and whatever indicator he's using is working. One example of that, I'm not going to name the person, but there's somebody that keeps posting in the Apex group Renko charts and talking about how great he is at trading the trends. He is completely full of crap, just so you know, okay? The guys that aren't posting crap like that are the guys that are withdrawing $200,000 from a 25K account. And there's a guy doing that, but he's not posting nonsense BS indicator crap all the time. He's just quietly, consistently trading his edge. And that's the right answer. So yeah, absolutely common thing. It's a good learning experience, Steve. That's really what it is. Yeah, I don't think they copy very many. I would think, they have a trader. I don't know what he's doing this year, but last year in 2022, they paid one trader over $1 million. And I suspect they're copying him because he's a really consistent and he's got a really good edge. And, that would be worth copying, but I doubt they copy very many. Remember, the vast majority of their traders blow up the PAs pretty quickly. Almost nobody gets to withdrawal. It's very unusual. And yeah, you see people posting withdrawals all the time. Yeah, it's about 1 to 2, 3% of the PAs. So, oh, wow, look at all these people making money. Yeah, but, they have tens of thousands of people trading, blowing up accounts daily. And that's what's paying the bill for the people that they're paying out. That's the business they're in. And, they're paying people to play a video game for money. The rules of the evaluators are not good risk management rules. They are designed for you to fail. A trailing drawdown is designed for you to fail because a new trader doesn't understand how to manage risk. So that's the game. And you got to learn how to play the game. It's not like trading. It's like playing the game with that rule. You got to follow the rules of the game you're playing. Let's see. The withdrawals for the last rolling month are posted in Apex website. Yeah, oh yeah, mostly small amounts, and mostly the people on their first or second or third withdrawal. And again, the number of people that get past that and continue with their funded accounts it's well less than 1%. There's a handful of them that do that. And some of those, get to that spot and then they blow up too. Or they decide at that point, they withdraw the money and they go trade a cash account with typical risk management, not trailing drawdown risk management. So great comments and conversations. You guys are right on the money here. So I'm excited to see that. And are there any other questions? We're going to wrap up because we have the other session in a half an hour and I need to take a little break. So if I don't see any other questions, I'm going to go ahead and end the session. I don't see any other questions. Thank you. Thank you, Steve. Thanks, everybody. Great session. You guys are getting this. I can tell by what you're asking me. And if it still seems, well, wait a minute, I don't get that. Trust me, the pieces will come together. You'll get it more and more. Today's conditions are just really tricky. And, that's why we scheduled sessions at various times of the day and different days. And, any day there's a big economic number coming, the market's going to be in price discovery because nobody really knows what anything is worth until we see what the different members of the FOMC committee said. We know the result of it, but we don't know who said what and how important, how much weight they put on it. All right. Thanks, everybody. I appreciate the feedback and all the great questions. And we'll see you for the FOMC minutes in about a half an hour. Thank you, JVC.
Yep. See you there.
See you later.